All right, welcome to Coffee with Markus. This is episode 63, and today we're going to talk about the markets, talk about the top three stocks of the day, and since we have talked about option spreads, we'll talk about a special option spread, the poor man's covered call. So we'll talk about what it is, when should you use it, and specific examples. Sounds good? All right, so let's get started. Now, if this is your first time here, welcome. I am Markus Heidkotter. And before we get started, let me just give you a super quick intro why I am doing this show. Because here's what I'm seeing. Most people who start trading expect their account to explode, and they've seen all these ads and emails that promise them to turn $2,000 into $1 million or something crazy like this. And then they start trading and they quickly realize that it doesn't work this way. So if you are sick and tired of all the hype and empty promises, then this show here is for you, because my goal is to give you the strategies and the tools that you need to be successful. Because the last thing I want to see is you losing your hard-earned money. Now, here is my promise to you. I will only show you strategies and tools that I personally use in my trading, plus I'm keeping it real. I'll show you all of my trades, the winning trades and the losing trades. No hype, just the facts, so that you have the right tools, strategies, and also the right mindset, because I want you to succeed. And if this sounds good to you, then click on like right now, or just type yes in the comments and we will get started. Awesome, good. So let's get started. Let's talk about the first segment in the show here. In the next few minutes, I want to show you what is happening in the market. And this segment, the first few minutes here, is for you so that you know what is happening right now. Let's take a look at the markets. The S&P right now is pushing higher. So is the Dow and the Nasdaq. But overall, as you can see, the markets are diddling around. And yes, this is a technical term. If it isn't, now it is. So on Monday, we were higher. On Tuesday, we were lower. Today, on Wednesday, we are higher again. Let's take a look at a 5-minute chart. And looking at a 5-minute chart, it becomes very obvious what is happening right now in the markets. You see, this morning, we were going higher, we were going lower, going higher, going lower. Right now, we are diddling a little bit higher. We are still not at highs of the day. So what the heck is happening here? Why are the markets just trapped in this box here that you see right now on the screen? Well, there is no real news. Yes, of course, we see that there's a spike in coronavirus cases. In fact, right now we have as many cases as we never had before. But you see, this has been going on for already 2 weeks. So this is no real news. The economy seems to be doing okay based on the reports that we see, the economic reports. And right now, it seems that the markets are waiting for some major news. And I believe this diddling around might continue this week, because next week, as we are going into the second week of July, we have major corporations reporting earnings. So next week, we will start hearing from major corporations of what is happening, how the second quarter, the last quarter when the coronavirus hit us, has impacted the companies. Now, one of the things that I noticed today, or that you might have heard, gold is trading at a 9-year high. And gold is usually the flight to safety. So is this telling us something? But you see, in the past, it was always like this. When gold moves up, the stock market moves down. But recently, it has been decoupled. So it is just notable. Know that there is a flight to safety, that we actually see some money pouring into gold right now. But if you look at this graph here, so this is from the Fed, this is where you see how much money is in money markets right now. So there's trillions of dollars sitting on the sidelines, waiting to get back into the market, waiting to get back into real estate. And as you know, in a money market account, what are you getting? Like 0.1%, 0.2%. So I mean, something eventually will happen in the markets, whether it's going to the upside and the downside. Right now, it seems that some investors are moving into gold, which is really surprising to me. Now, talking about surprising, let's actually talk about the next segment here, the 3 hot stocks. And here's why I'm mentioning it, because I think if a friend asks you, so, hey, what's going on in the markets today, then the first few minutes of this show will help you to sound super smart because I hope that I can share something with you that you didn't know. One of the stocks that I want to point out is not really a well-known stock. It is Taylor Morrison Homes. It's not YMCA, it's TMHC. So Taylor Morrison Homes today jumped up 15%. Now, why is this significant? Taylor Morrison Homes, that sales orders last month in June nearly doubled compared with last year. Now, as you know, when we started this pandemic, everybody was concerned that the market is tanking and that the real estate market is tanking. But it hasn't happened. Now, the reason why people thought the real estate market would tank is because they thought about 2008, where we had a financial crisis that impacted the markets and then also the real estate market. But right now, we don't have a financial crisis. We have a health crisis that has an impact on the economy. And this is why it is so important that it's two different things. So if you're comparing what is happening right now in 2020 to what happened in 2008, you're wrong. You can't compare this. It is two separate things here. Anyhow, so this is something notable that stands out. And then we have, of course, Walmart and Amazon. So let's take a look at this. Walmart announced yesterday that they are introducing Walmart Plus. Now, you might be wondering, what the heck is Walmart Plus? Well, this is the equivalent to Amazon Prime because, believe it or not, Walmart has been taking Amazon as a shopping site. Take a look at this. This is Walmart.com. So no longer do they show you the ad of the week or something like this. No, it is a full-blown shopping site. Take a look at Amazon. Does this look very similar? Here's Amazon. Here's Walmart.com. Do they look similar? So what happened yesterday, Walmart actually said we have Walmart Plus, which is comparable to Amazon Prime. So Walmart is definitely taking on Amazon. Now, does this affect Amazon? Not really, because Amazon today is up 2.5%. Why? Because they do have the market share. I mean, think about it. If you want to buy something, where do you go? Do you go to Amazon or do you go to Walmart? So, yes, Walmart is taking on Amazon, but I believe right now, based on what we see here, also on the charts, Amazon is winning the war. Okay, so again, in a few minutes in the beginning, I want to show you what is happening in the markets. Let me actually come back here to my nifty agenda. So we talked about what's happening in the markets. We talked about the three stocks of the day. And now I want to talk about the poor man's covered call. And then as always, I'm taking your questions. So that's what we do at the end of the show. If you're live here, leave a question in the chat box here. If you're watching the recording, leave a question underneath the video here. Talking about questions, so good to see everybody here. See a bunch of yeses. Good afternoon, everyone. Okay. Good. So let's talk about poor man's covered call. What is it? Who is this for? And when to use it? And as always, I want to show you very specific examples. So let's actually jump onto the notepad here. And the reason why I'm talking about covered calls today is because the poor man's covered call is a very specific type of spread. And as you know, we have been covering, let me just bring it up here, option spreads for the past few sessions. So we actually have a playlist right now that shows you everything that you need to know about option spreads. So here what you see is an option debit spread, and this is from a video that I did earlier. So today I want to talk about a covered call, and I want to show you exactly what is the difference between trading stocks, trading a covered call, and trading a poor man's covered call. And also want to talk about what is a poor man's covered call. So let's first talk about stocks, and I want to use Boeing BA as an example. Let's take a look at a chart of Boeing right now, see where we stand. So as you can see, Boeing right now is trading at $180. Dead smack, okay? So let's say that you are bullish on Boeing and that you expect that Boeing will go higher. Let's just say, right? So this is where many people start with trading stocks. And therefore, when trading stocks, you would buy 100 stocks of Boeing, and you would buy it right now at $180. So again, stick with me because I want to show you what it means when you're trading stocks, when you're trading covered calls, and the poor man covered calls. So the capital requirements, if you are trying to trade 100 shares of a stock, is here 100 times $180. So this would be $18,000. I'm going to make this a little bit smaller. So if you don't have a margin account, so right now I assume that you have, let's say, a retirement account or not a margin account. So you are buying 100 shares for $180 each. So that would be a capital requirement of $18,000. Now, let's see what happens if the stock goes up by a whopping $10. So if this happens, you would make $10. So if the stock goes up, Boeing from 180 to 190, you would make $10 times 100 shares. So you would make $1,000. Making sense? I'm marking this in green so that we know this is how we are making money. So that's super easy to understand. So you probably know already this, but stick with me because I want to show you the exact comparison of why it would make sense to trade a covered call, and also what the heck is this poor man's covered call and when to trade this. So if the stock goes up from 180 to 200, you would make 20 times 100. So you would make $2,000. Super easy to understand. Let me just remove this, the spacing in there, so that I don't have to go into two lines. Now let's say what happens if the stock drops by $10. Well, what would happen is you lose $1,000. 10 times 100 means that you lose $1,000. So this is a negative of $1,000, and since it is a negative, I'm going to mark this in red. So super easy to understand, and this is what most people do when they start trading. They start trading stocks, and then as they're getting interested in options, the first strategy that most people do is trading a covered call. Now, first of all, let me show you as we are going to Boeing here. Let's just say right now I'm going to the analysis. We would buy 100 stocks of Boeing, and it's moving around a little bit, but we say we would do it for $180 here. So let me just lock this in for $180. There we go. So in this case, let me just go to the analysis. See, super easy to understand. That's what we talked about. If we go from 180 to 190, we are making $1,000. Here we are making $2,000. And as the stock price goes down, we are losing money. This is what you see here on the screen. Now, if you look at the chart, you might say, you know what? I think that Boeing will go up in the long run. But over the next few weeks, looking at the chart here, I don't think that Boeing will go above $200. I'm marking it right here. So let me just be exact. This is supposed to be $200. So this could be the opinion of the market. So they say in the long run, over the next few weeks and months, let's say over the next few months and years, Boeing will go up. But I believe that over the next few couple of weeks, let's say over the next 10 days, Boeing will not move higher than $200. So here's why this is important. For the covered call, you would now say, okay, I buy 100 stocks at 180, and at the same time, I'm selling a 200 call. And here we would say, you know what, today is July 8th. So let's say for the next 10 trading days. So we would sell one that expires on July 24th. Now, let me show you exactly what happens when we do this. So I will here add another trade into this. For July 24th, I will sell a 200 call. And you see, for the 200 call right now, we are getting $4.50, I would say. Yeah, $4.50. That sounds about right. Okay, so let's take a look at this of how this affects our equity curve here. So as we're selling it. I accidentally bought it. Let me just change this. We We are selling a call. Did I write this down correctly here? Yes, we sell a 200 call. So the capital requirements, when you do this, when you sell a call against stocks that you own, it is still the same. You don't have to bring more capital to the table. So it is still $180,000, $18,000. Okay. So what happens if the stock goes up? Now, first of all, as we sell this 200 call, we are receiving $4.50. Now, options trade in 100 packs, so we are receiving $450. So if the stock goes up by $10, we are making the $1,000 that we would make with a single stock. But we also, in addition, we are making plus $450 the premium that we received for selling the call. When we sell a call, we receive a premium, and this is what we get. So this means that we make a total of $1,450. And you already see the difference here. So by adding a covered call, if the stock goes up by $10, not only do we get the $1,000 from the stock rising, but we also get the premium that we actually receive by selling the call. So we are increasing our gains by 45%. Now the same here, if it goes up to 200, we are receiving $2,000 plus the $450. Okay, so this means we make $2,450. So again, we are making more than we would make if we would only trade the stock. Now here is the cool thing. And you know that we have been talking about debit spreads already. So why would you trade a debit spread? Why would you sell a call against stocks? Well, not only to increase your gains, as you can see here, but also to reduce possible losses. Because if Boeing goes down to $170, you would lose the $1,000, but you're getting the $450 in premium. Therefore, you're only losing $550. Okay, so let's do a minus. There we go. So as you can see, it does make sense to trade a covered call. This is why many stock traders, the first thing they do when trading options is selling a covered call, because you're amplifying your gains and at the same time, you are reducing your losses. So is this making sense thus far? Because I want to show you what the poor man's covered call is. I want to show you exactly of what are the advantages and disadvantages of having a poor man's covered call. But I want to make sure that this is helpful. If it is, do me a favor and click on like really quick, or just say yes in the comments so that I know that I'm not going too fast or too slow, that I'm actually going at the right speed. Okay. Sounds good. I see a bunch of likes. Awesome. So let's continue. So why would you trade a poor man's covered call? When would you trade it? So again, the idea is when to trade a poor man's covered call is if you don't have $18,000 in your account. Because you see, this is what is required when you're buying 100 shares of Boeing. And let's say that in your account, you only have $10,000. So you only have half. So how does a poor man's covered call works? Instead of stocks, you can buy an option. And you would buy an option that is deep in the money. So let's talk about this here. What is it? So we already know that we are talking about a poor man's covered call. Okay, so instead of buying stocks, which is expensive, you would buy a deep in the money call, and I'm showing you an example here exactly in a moment, at a later expiration. So not at the same expiration, because in the long run, again, as you remember, in the long run, you think that the stock stays above the current price and moves slightly higher. So this is where, let me just write on the idea, when and what is it? So let's talk about it. Let's actually jump to the chart here. So we sold the July 24. The first thing I want to do here is get rid of the shares, because instead of the stocks, we want to buy an in-the-money call. So that's what we're doing. We're going to the table. We are going out a month or two. So usually it's 1 to 2 months out. I choose a little bit less than 2 months out. So the September, and I'm looking at the 110 call. Now again, right now Boeing is trading at around 180. So why do I go for the 110 call? Actually, we could, the 110 call is good. We want to see a delta of 0.95, because what does it mean? A delta means that if the stock is moving $1, the option is moving 95 cents. And you see, the deeper in the money a call, the higher the delta. The delta is usually never 1, and I like to have a delta of, let's say, 0.95. So here we don't have exactly 95, so I go for 110 call, and this is what we want to buy. So we are buying the 110 call. As you can see right now, it costs around, let's say, difference here between bid and ask is $71. So let's talk about it. So the poor man's is we are still selling the 200 call, and now we are buying the 100 call with an expiration of, what did we say, September 18th. There we go. Okay, now what are the capital requirements? So we are no longer buying the shares, we're buying the call, and we are buying one call, which is basically for 100 shares, and we are buying this at $71. So this means our capital requirements are $7,100. As you can see, this is a fraction of the cost for buying a stock. We are still, what we are doing here, we are still selling, let me just copy it from here, the 200 call. But the main difference here is, instead of buying a stock, we are buying a call. So now let's see what happens if the stock goes up from 180 to 190. And this is where we're going to our risk graph. And we see if it goes from 180 to 190 right here, you see that now we would make $1,335. So let's write this down here. We make $1,335. As you can see, this is slightly less than the $1,450 that we would make with a call. Why? Because again, the option has a delta of 0.95, so it only moves 95% of the stock. So if the stock moves $10, the option would only be worth $9.50 more. Is this making sense? Okay, good. So if it is making sense, do me a favor and click on like. If it is not making sense, post a question either in the chat if you're watching this live or underneath the video, and I'll look at the questions here in just a moment. So let's see what happens if the stock goes up to 200. And we're going back to our risk graph here, and we see if it goes up to 200, we make $2,320. You see it right here. So we will make $2,320. So again, as you can see, not as much as we would make with a covered call, definitely more than we would make with a stock. And here's the cool thing, but you need much less money, okay? So let's write this down here. So the cool thing is, with a poor man's covered call, you're almost making as much, you make 95% of the money that you would make with a covered call. You would make more money than just having an outright stock, and you need to bring much less capital to the table. Okay, now let's talk about, of course, when the stock is moving against us. So when the stock is moving against us here, and we say it goes down to $170, so we look it up here. If we are at $170, we would lose $675. So here we're losing $675. So we're losing a little bit more than we would lose with a covered call, but not as much as we would lose if we would only trade the stock. So as you can see thus far, it sounds awesome. Why wouldn't you trade the poor man's covered call all the time? Why are people trading stocks? Well, that's what I want to show you right now, where the problem is, so that you know that there is a downside to this. I mean, there's always a downside to it. So the problem starts if the stock goes up above the strike price that you're selling. Because with the strike price that you're selling, you basically say, I am willing to sell the stocks at $200, right? So if you just have the stock and it goes up to 220, you would make $40 times 100. So you make $4,000. Nice, right? I mean, this is assuming that Boeing jumps up to 220. So let's mark this in green. What does it look like here? Well, again, you're capped because you bought the stock for $180, but you have to sell it at $200. So this is why on the stock, if it moves up to 220, you only make $20. So 20 times 100 is $2,000 for the stock, plus, of course, the $450. This is the premium that you always get. So as you can see, it would be $2,450. So you're capped here, meaning that you don't make as much as having the outright stock. Okay, let's mark this in green. Now with the poor man's covered call, this is very similar to a covered call. So you are capped. Let's take a look at this. What is your cap here? It is $2,320. So let's go back here and you see it is $2,320. So this brings us back to, we talked about it, what is a poor man's covered call? Instead of buying stocks, you would buy a deep in the money call at a later expiration. When should you trade it? If you don't have enough money in your account, but you want to trade more expensive shares. And the important thing is, the idea is that the stock stays above the current strike price and moves slightly higher. Now, here's the deal. This cap that you put on the stock expires in 10 trading days from now, 7/24. Today is July 8th. So, and again, we have 2 weekends in between. So this is why it expires in 10 trading days. So as long as Boeing stays below 200, it definitely makes sense to trade the covered call. And do you actually lose money if Boeing would go above 200? Do you lose money? No. The only thing is that you wouldn't make as much money as if you had traded the outright stock. But overall, as you can see, the advantages of trading a covered call or trading a poor man's covered call, if you're long-term bullish on a stock, that's the important thing. If you're long-term bullish on a stock, then the advantages of trading a covered call or a poor man's covered call outweigh the disadvantages than trading a stock. And before you trade a covered call, if you don't have any stocks in your portfolio, consider trading a poor man's covered call. Well, has this been helpful? I hope it has. If you enjoyed this video and would like to see more videos like this, consider subscribing to the channel and hit the little bell, because this way you get notified whenever I release a new video. And now, enjoy any of the videos that hopefully pop up on the screen right now, and I'll see you in the next video. All right, that's always the sign for Asia to edit this out. And I mean, right now, let's talk about what we have covered thus far. We talked about the markets. We talked about the top 3 stocks of the day. We talked about what is a poor man's covered call. So now my favorite part of this show, your questions. So let's jump right over and let's see if there are any questions. Oh my gosh, there are a lot of questions. So let me find them and let me display them on the screen. If I can find them here, hold on 1 second. So, one of the questions is from Ken, what is the best way to get started in options? Ken says he has been sitting on the sidelines with trades due to the high VIX. Think about starting conservative trades for a while. You see, the best way to get started with options, Ken, this is a great question, I believe, is just buying calls and buying puts. because by doing so, you're limiting your risk to the amount of money that you pay for the call or what that you pay for the puts. I have a playlist for you, and I have a course for you that you can watch on your phone. It's called Options 101. And if you go to rockwelltrading.com/101, you will see exactly how to buy calls and puts, and you learn the basics about options. So this, for me, would be step one. And probably the team is posting the link in the description here. So the course is free. You can have it for free. So there's a good way to start. The second way is thinking about debit spreads. And we covered this in a previous video, so we link to this in the description. At some point, this video will be in a playlist, so the earlier videos in the playlist are showing you how to do this. So Ken, what is the best way to get started in options? First, buy calls and buy puts. Step number 2, start thinking about debit spreads. And I did a video on this, so take a look at this. Hope this helps. So Ricardo is asking, but what if we sell a call? It's not that we expect the stock to go down. No, you don't expect the stock. It's a great question. Yeah, what you expect here, let's actually jump back. You see, how do you make money? You make money right now. We are right here. We are right here. You start making money if the stock moves higher. So you're selling a call, but since you have bought a call or since you own the stocks, you're expecting this to go higher, but you don't expect this stock to dramatically jump higher. So you can do this with Boeing, you can do this with Apple, you can do this with Tesla, you can do this with any stock where in the long run you expect the stock to go up. So great question, but now you know. Does this help? Good. Okay, so I see that everybody's agreeing that this was helpful. Okay, so Shamar is asking, I found that the delta is not close to how the options move. Is it more a guideline or supposed to be accurate? You see, the delta in option prices are influenced by many factors. They're influenced, obviously, first and foremost by the stock price. Secondly, they're influenced by volatility. Third, they're influenced by the time value, how much time is left. So the delta is pretty much changing every day. So therefore, Shamir, you're absolutely right. It is more of a guideline. But especially here, for this very specific idea, you see, we are buying a deep in the money call, and therefore the delta is pretty accurate. You see, if you look at deltas that are closer, let's just go back here, that are closer to the current price. So if you're looking here at a delta of 0.56, 0.52, this is not very accurate. It's more of a guideline. But great question. Okay, so let's see. Richard says, wash hands. Please do. Let's all stay safe, right? Let's be responsible adults here and make sure that we're nipping this nasty virus in the bud. Okay, so Anthony, great question. Isn't this a calendar spread? Yes, it is a vertical calendar spread. The reason why I called it the poor man's covered call is because somehow it seems that many people, and I received this question, what is a poor man's covered call? And here's the good news. In order to trade this, you don't have to be poor and you don't have to be a man. You can be rich and you can be a woman in order to trade this. So it's just the way how it is called. And you're absolutely right. Technically, it is a calendar spread. So, yes. Okay. So Ricardo said, sorry, I prefer stocks. There's nothing wrong with trading stocks. Just, you see, I want you to know the possibilities. I would never say you have to trade this. But I want to show you what are the advantages of trading covered calls or poor man covered calls over just trading stocks. And there are advantages, and the disadvantage is that you're missing out if there's an explosive move in the next few weeks until the call that you're selling expires. Okay? So again, of course, you're all adults. You can do whatever you want. I just think it never hurts to learn anything, because here's what I like to say: you can never learn less. And when it comes to the markets, this is what I have experienced. In the markets, it is not the bulls versus the bears. It is the educated versus the uneducated. And this is why we're having the show. And there's three things that you must have. Number one, you must have a solid trading plan. And a trading plan says exactly what are you trading? And to your point, this could be I'm only trading stocks, or I'm trading covered calls, or I'm trading the poor man's covered calls, or I'm trading debit spreads, right? So you need to know in a trading plan, number one, what to trade. Number two, you need to know when to enter. Number three, you need to know when to exit. When to exit with a profit and when to exit with a loss. Now, the second thing that you need in order to succeed with trading is professional tools. You know me, I like to use the PowerX Optimizer. Many of you who are watching are using the PowerX Optimizer. It is my favorite tool because it helps me with all these things of a trading plan. It tells me exactly what to buy or sell. It tells me when to enter, how many shares to trade, and it tells me when to exit. Now, the third thing is that you need to have the right mindset. We talked about it in the intro. Trading is not a get-rich-quick scheme. Trading is a profession. You will have winning trades and you will have losing trades. The key is to keep the winning trades bigger than the losing trades, because this is how you win in the long run. By the way, I explained everything in detail in this book, The PowerX Strategy. And it's a book, I think it's awesome because I've written it. If you would like to have a copy of this book, we're posting a link in the description here. I'll be happy to send you a copy of the book. It's a hardcover, 150, 160 pages. And all I ask is that you pay for shipping and handling. And shipping and handling is $4.95. So no strings attached. If you would like to have a copy of the book, follow the links in the description or in the chat right here. And I'll be happy to ship you one. Okay, let's see. There are a few questions. So Honest Quester says, did you forget to add the money you got when you sell the call, or is that in your numbers? That is in my numbers. So you see, when I'm selling the call, I'm getting $450 right here. Okay, so it is in my numbers. I factored this in. But thanks for the reminder. Always good to double check and to make sure. Okay, so let's see. The covered call. Okay, Ned, there's an excellent question from Ned. So Ned says the covered call at 220 should be 4K plus 450. Is that right? No, it is not. Because that is the deal. With a covered call, you're limiting your profits. You can only make as much as between the price that the stock is currently at and the call that you sold. Because when you're selling a call, it means that you have to sell the stocks at the strike price. So therefore, even if it goes up to 220, you're limiting yourself to the $2,000. That is the main difference. So no, I did this correctly, but thanks for double checking me. By the way, if you're a little bit confused about the strike prices, the expirations, I do have a course. It's called Options 101. And you can have it for free if you want. Just go to rockwelltrading.com/101. We're posting a link here in the description. This is where you can learn the basics about options and what does it mean to buy a call versus selling a call. What does it mean with the different strike prices and so on. So good. Okay. So Caleb is asking, how is a poor man's covered call different from a spread? It is not. It is a specific type of a spread. And the reason why it is a specific type is, let's go back to the screen here, is first of all, it is a calendar spread. So you're having two different expiration dates and you're buying a deep in the money call. So this makes it a very specific spread. So you're absolutely right. This is why I'm covering it here in the series under option spreads, because it is an option spread, right? It's just a very specific option spread. So that's what we are doing. Okay, Devin is asking, how is your $20,000 account doing? It is actually doing really well. As you can see today, most of the positions are up. So right now the open P&L is $1,731. So this means that, as you know, I went into a drawdown. So this account, I started with $20,000. over the past few weeks, especially in June when the markets were just going sideways. Let me show this to you here. Yeah, so when the markets were just going sideways, chopping around, I lost 10% of the account. So I lost $2,000. And right now I'm making back, I mean, those, knock on wood, so far so good, right? So I'm making back $1,700. So this starts to look good. So therefore, right now, the account is slightly down. It's down by $300. But yeah, great question. As I said, no problem. Showing you of what happens. Today was a good day. Yesterday was an awesome day. So TVTY is an option that I will cut loose tomorrow. And if you see after this, pretty much with the exception of Dan, all of my positions are in the green. VIAC today went slightly down. I'm pretty sure that it'll bounce back. Anyhow, great question. Thanks for asking. Okay, Mike is asking, is the debit spread talk from last night recorded for later viewing? I was pretty late here in Spain for joining. Yes, it is, and you should have received an email from us. If you did not receive an email from us, please do me a favor, call or text the office or send an email to support@rockwelltrading.com. Otherwise, it is in the member section of the PowerX Optimizer. So for all of you who already have the software that I personally use, the PowerX Optimizer, you have access to the class from yesterday automatically, and it is in your member section. So, and if you haven't received an email from us just yet, check your spam folder or just call, text the office, send an email, and we'll send it over to you. Okay. Good. So, let it be. CH, have you finished 40 trades on Tastyworks? No, I am at 39 trades. So I am at 39 trades. So close. And I'll share the results with you at some point. Okay. So Donna is asking, when you leg out of the spread, if you take profits between the conservative and optimized targets. Donna, this would be a great question for the Facebook VIP group because this is very specific here. And again, if you did attend last night's class, right? You know that we presented 3 strategies, right? And one is the conservative one where you would leg in right away and then you leg out as you get to the conservative or optimized profit target. But this question is better asked in the Facebook VIP group. If you are a PowerX Optimizer user, you have automatically access to this. So please go there. We'll make sure that it gets answered there. It would be a little bit too long to get into this here right now. So Bruce is asking, but the poor man's covered call isn't really a covered call. Well, kind of, right? Because this is where we are going back. So it is covered in the sense that you own a call that basically says you are allowed to buy 100 stocks of Boeing at $110. So as long as you have this, then it is considered somewhat a covered call. Usually covered call is when you own the stock. So here, just to be very specific, a covered call usually means that you are first buying the stocks and then selling the call, but you can substitute the stocks with a deep in the money call just because it is cheaper. You see, the margin requirements is way lower. And if you have a margin account, it is even lower than that. Anyhow, good. All right, so let's see. There were a few other questions. Jean LaRouche asked, I see it here, in a poor man's covered call, do you leave the call expiring? The call that you sold, yes, because this way you're keeping the premium. Now, if you see that this call goes down to, what did we have here, $4.50 to, let's say, 10 cents. Instead of going for $450, you might as well take money off the table. If you can reduce your risk, it is always helpful. So if you see that you don't have to wait until expiration, if you can realize most of your profits before expiration, I would definitely buy it back at this point and not really try to squeeze out the last $5 or $10 here. Okay, good. So let's see. Anthony's asking, do you sell the long and short call at the same time? You can, you don't have to, because here's the cool thing. You see, this call that you're selling expires 7:24. But you still have this call, right? So now, if this expires at 7:24, you can do the same thing again. You can do the same thing again. Now, you can sell, if you're going back to Boeing, to the table. So you have all these expirations. You have July 24th. Now you can sell a July 31st call, or an August 7, or an August 14, right? This is why I like to buy the call with an expiration that is 2 months out, because then you have an opportunity to repeat this and collect maybe another $450, maybe $400, maybe $500. So you don't have to do it at the same time, but here's the important thing. You must own the call before you sell another one. So here, always, first, buy this one, buy a call before you sell it, right? So that is the important thing. But otherwise, you don't have to do it at the exact same time. Anyhow, good. Len says, I love the different option strategies that you're showing us for different market conditions. You're welcome. Thanks for being here, Lance. It's so good to hear from you. We haven't talked in a while. Okay. So AD is saying, TD Ameritrade tells me if I deposit $500 into an account, I'm able to get real-time quotes on paper money versus the 20 minutes delay. Is it worth it? You see, when you open an account, as you see, I prefer Tastyworks. So I prefer Tastyworks. If you would like to have more information about Tastyworks, go to rockwelltrading.com/Tastyworks. And here, yes, if you open an account and deposit at least $500, you get free quotes. Now, is it worth it if you're planning on trading? Absolutely. If you never plan on trading, you can get real-time quotes, especially for stocks, for only $2 to $4, right? So it depends on you. You can go with TD Ameritrade. I personally prefer Tastyworks. And again, if you would like to have more information on this, go to rockwelltrading.com/Tastyworks. There's probably a link in the description here. Okay. Good. So, just have a sip of coffee. All right. Paula says, I ordered my book last week. How long does it take to receive? Paula, we are mailing it out the next day. So if you're ordering your book today, we are mailing it out tomorrow. However, as you know right now, USPS is quite a mess, even UPS. So we are mailing it ground. And based on what I've heard, if you are in the United States, it can take 7 to 10 business days. If you're international, right now, you know, international mail is a mess because of all this virus. So this is where it can take a little bit longer here. Anyhow, but good question. You should receive it rather quickly. If you want to know, I do believe, I hope that I'm not getting in trouble by saying this, but I do believe that we do have tracking numbers, so you can call or text the office, but wait until 10 days are over. Again, it's not our problem. We are mailing it out right away. It's really... I think we're mailing it by USPS or UPS. Not quite sure. They sound so familiar, sound almost the same. So I don't know, because I'm not mailing the books. Anyhow, so good to be with you. My gosh, time is flying when you're having fun. So right now, we're a bit after the time, but let's take a quick look of what we covered today. If you're just tuning in, here's what we talked about today. So episode 63. Talked about what's happening in the markets. We did talk about the top stocks of the day. We talked extensively about the poor man's covered call, and I answered many questions around this. Hope that you enjoyed the show. If you liked it, please click on like, and also make sure that you subscribe to the channel. Hit the notification bell. This way you get notified whenever I go live or release a new video. And please do me a favor, and if you like the video, share it with your friends. Share it on Facebook, share it on Twitter, share it on Instagram, share it on, I don't know, by email. Share it with others who you believe might benefit from this information. I'll be back here on Friday, 3:30 Eastern Time, 30 minutes before the markets close. Talk more about trading strategies, tips and tricks that you can use in your trading right away, and hopefully that make you more money. All right, have a great rest of the day, and I'll see you in the next video. Take care, everybody.